Budgeting is the backbone of FP&A. Working with budgets is more than just working with numbers. It is aligning people and resources with strategy while staying flexible for unexpected changes that might happen. In this video, we'll break down what budgeting means and how you can confidently explain it in your next interview. But before we talk about budgets, here are some of the other variations of this question that you might encounter in the interview. What does budgeting mean in FP&A? Can you define budget and its role in FP&A? Why is budgeting so important and how it is done? Could you walk me through a time when you have prepared a budget in your previous role? What are the steps to create a budget? And finally, explain budgeting to somebody who's not working in finance. Now that we've looked at the various ways this question might be asked in the interview, let's dive into what budgeting really means in FP&A and also why it's so important for any company's success. A budget is a blueprint for how the company is expected to do business in the next financial year. It forms the basis of business operations in the next year. It dictates important decisions relating to where to invest, what costs to cut, where to allocate more resources, and what specific areas to focus efforts on. Budgeting is the process of translating a company's long term vision into actionable plans for the upcoming financial year. For example, if a company wants to double its turnover, triple its profit, and expand into two new geographies over the next 5 years, these ambitions need to be broken down into concrete measures and annual targets. That's where budgeting comes in handy as the company's financial blueprint for achieving these goals. At its core, a budget is essentially an estimated income statement for the next financial year. It includes projections for revenues, expenses, and operating profits, resembling a P&L or an income statement. Companies may refer to this process using different names. It could be annual business plan, annual operating plan, commitment, or targets. But the essence remains the same, planning the financial trajectory for the upcoming year. Now, in some cases, budgeting is a part of a broader annual operating or business plan. While a budget focuses on financial metrics, an operating plan may also include qualitative elements like strategies, tactics, and actionable steps to achieve the outlined financial goals. Ultimately, budgeting ensures that a company starts its financial year with clarity and direction, aligning resources and efforts to meet its strategic objectives. So, whether it's called budgeted revenue, committed profit, or simply the plan, the idea is to provide a structured approach to what organization aims to accomplish in the upcoming year. FP&A Professionals Institute, our mission is to help 1 million professionals master finance and FP&A skills. FPI offers comprehensive FP&A certifications and programs tailored for all levels. Visit our website www.fpnaprofessionals.com to learn more and kickstart your FP&A journey today. Now let's get back to the video. Now that we know what budgeting is, let's look at why it is so important. Budgeting plays a crucial role in ensuring that a company's strategic goals are effectively translated into actionable plans. Here are four key reasons why budgets are so important. First is budgeting helps a company prioritize its resources and efforts. It identifies key focus areas, for example, which products or geographies it needs to target. This clarity ensures that the organization's energies are aligned with its strategic objectives. Budget also helps create a phased spending plan. Budgeting provides a structured roadmap for resource allocation. For example, if a company plans to hire 50 new employees in the next financial year, the budget will outline when and how many hires will occur in each quarter. This ensures optimal timing and efficiency. Next is that budget also holds management accountable. A budget sets a measurable target for senior management and operational teams. These targets are often tied to incentives, performance metrics, and variable pay. Let's take an example. A CEO's target may be filtered down to business unit heads, sales managers, and officers, ensuring accountability at all levels. And finally, it helps in managing cash flows effectively. Especially for businesses with seasonal cash flows, budgeting provides a clarity on cash surpluses and deficits. It helps the company plan for credit lines, bank overdrafts, and maintaining banking relationships, which ensures that liquidity is maintained throughout the year. With a clear understanding of what budgeting is and why budgets are important, now let's talk about the key steps involved in the budgeting process. Budgeting is a structured exercise that translates a company's strategic goals into actionable financial plans. And here are the key steps involved. The first step in budgeting is liaising with the business teams. Budgeting process begins with collaborating with business units to understand their outlook for the upcoming financial year. Let's take an example. In a big conglomerate company, there are central finance teams who liaise with the business unit teams. For example, there are three departments in this case: jewelry, eyewear, and watches. FP&A teams will gather details on projected revenues, expenses, and margins from each of these departments or business units. The next step is analyzing historical data. Now, historical data is analyzed at two different stages. The first is before the discussions begin. This is when you prepare templates to gain context for business inputs. And the second stage is after the input collections. This is to validate assumptions against historical trends and investigate variances. For example, if there is unexpected growth or decline in revenues. Next, the FP&A team would provide proactive guidance. FP&A teams may identify overlooked cost areas or areas needing attention. For example, if a business unit budgeting for an annual customer event, the FP&A team will ensure that such costs are captured by revisiting the historical data and questioning the assumptions. The next step is to compile the budget. Once all the department inputs are collected, the company-wide budget is compiled, consolidating revenues, expenses, and profits into a single financial plan. In the next step, we do reviews with the senior management. The consolidated budget is presented to senior leaders like CEO and CFO, business unit heads, and board of directors. Feedback is incorporated to multiple iterations. For example, adjustments are made for aggressive or conservative targets until the final version is approved and frozen. Now that we have finalized the budget, the last and the final step is to upload the budget in the system. The finalized budget is uploaded into a system which can be either an integrated ERP system that provides real-time control by blocking expenses that exceeds the budget limits, or it could be an Excel or external planning tool. In this case, we maintain flexibility, but we need to make sure that there is manual oversight to prevent overspending. The budgeting process often involves several versions. For example, version 1, version 2, version 3, before final submission, ensuring that there is alignment across all levels of the organization. Typically, budgeting begins 2 to 3 months before the start of the financial year. For example, if you are planning for FY 2026, the budget cycle might start in September 2025 with multiple iterations leading to the final sign off somewhere in November or December 2025. Download free resources on FP&A interview preparation. Check the links in the description. If you would like to understand the budget cycle in more in depth, please check the detailed webinar on this topic. Thank you for watching, and I will see you in the next video.